lesson last week is trend following is a systematic investment strategy that seeks to profit from long, medium, and short-term trends in the market based on the assumption that price trends tend to endure, or simply meaning that trends continue until they don't. And as we showed in the last training, is that we can show an uptrend based on connecting the lows, and that trend will continue until that trend line's broken. Then we'll see a reversal, a downtrend will happen, which we connect the highs, and vice versa. If you want to learn more about that, you can go back to that video, or we can cover it in the questions and answers if you have that then. Here's some articles and papers written on trend following if you want to go through the math of it. Not required at all, but again, there's one paper that wrote a centuries of evidence on trend following investing that shows that it consistently beats the market. And then there's also another report done in 2014 that shows 2 centuries of trend following data that also shows that it outperforms the market, specifically in times of uncertainty, which is kind of the market that we're in right now.
Okay. So how are you feeling personally?
Oh, I'm unfazed because I know my plan will change based on what the market does. Currently, we're bullish, so I'm following the bullish strategy. If that changes, of course, I'm going to take a couple losses, but then my strategy switches like the system tells me, which we'll be covering in today's video. But no, I'm unfazed. I don't really care what the market does, up, down, crash.
Right. So you still, given the crazy market situation right now, you're still feeling that you're just following your trend following trading platform system algorithm, just sticking to it.
Yep.
Perfect. Thank you.
Yeah, so looking at the indicator here, this is the backbone of the strategies that we use. And so I want to make sure that I cover this in depth first. All coaching clients have lifetime access to this, which is something that I never do, but now you guys have access to it. So if you don't currently have access to it, just send me your TradingView username and I will give you access. But when we're looking at this here, we need to break down some important points. As we mentioned, or as I talked about in last week's training of how to kind of chart out support and resistance and trend lines and stuff like that, this indicator, this mathematical basis, which we'll talk about here in a second, does a great way to visualize the trend. And so what I mean by that is simply, if the stock is above this green line and we're in this little range here, the market is bullish. So the market is bullish all in this range that we are in right now. When the market's in this middle range, this gray area, it is in a gray area where it's very sideways, unpredictable. It can go up or down in an instant. This is typically where we see those movements where it goes up, down, up, down, up, down, up, down, where it gaps up, then goes down, or gaps down and goes up. And then we just see those weird price actions. Most of that happens during sideways range-bound price action, which is found inside this middle 2 lines. Below the red line is indicative that we are trending down. We are now in a bearish market or trending down. And so again, that's what we see here below the red line. So again, what we see here is this visually shows the trend, but again, mathematically, what does this mean? Well, if we see here, this gray line that we see going, cutting through the middle of the chart is the 200-day moving average line. This line indicates the average price over the last 200 periods. Since this chart is a daily chart where each candle represents 1 day, that means that this price right here, roughly around 410, is the average price for this stock over the last 200 days. And so again, we can just see what the average price is, and this is just a very good indication. Why? Well, because as we know, the stock market is very psychology based and has a lot of what everyone thinks will happen happens type of philosophy to the stock market. And so a lot of people who don't know how to read a chart will go in and understand that, hey, there is some type of movement to a market, and most of the financial sector will look at the 200-day moving average and be like, okay, if it's above that line, we're more bullish. If it's below that line, we're more bearish. And because most people look at that for their common assumption of bullish and bearish, that's that's what we base our framework off of. You can also look into those math articles and papers and reports written that I showed you at the beginning. The 200-day moving average is something that is always there just because it's a consistent way that everyone uses to assess trend. And when everyone uses something, that means they're all watching it. Most likely it's going to happen. And so again, that's why the 200-day moving average is our basis for this indicator. Then what we do is based on the volatility of that stock, we determine what the normal distribution curve is for the current price. So for instance, it looks at over the last year, and over that last year, we understand, okay, what is the volatility over that last year between the high and the low and what's going on? Then once we have that, we determine the distribution. So this green line is a +1 standard deviation of this middle line. The red line is a -1 standard deviation. So this is where most price activity will fall. And then we have the range where it starts trending outside of that. Then we have these yellow lines on the upper and lower range. That's going to be our 3 standard deviation lines. Why? Once you hit outside of 3 standard deviations, you're pretty much exceeding what's acceptable. So again, you're roughly trading outside of the 99.5% somewhere in there normal trading range. And so when you break out of that, typically there's a rejection back down. So that's why you can see here when we hit this yellow line, we tend to see bounces in the stock. When we hit up here, we tend to see some type of retracement or at least a pullback. And so that's kind of what we're seeing here. And this idea of mathematically using normal distribution to understand trend up, down, too far down, too far up, and then more of a sideways market as the basis for our trend following approach. This is the system and indicator that I've used to kind of trade stocks for the last 5 years, and now recently apply credit spreads to it. And that's the strategies and rules that we'll be discussing. This is the backbone of it, and we'll come back to this chart after sketching each strategy after that. But with that, what questions do you have?
We have the yellow, green, red, and yellow again, right? Yellow, green,
yellow,
red,
green, red, yellow.
So like you mentioned that you have been using this indicator to trade stock and recently moved to indexes. Could you share, I know now you preach about just trading using this indicator to trade ETFs, S&P 500, etc. So why did you decide to start doing that instead of applying this to stock again? May I understand why?
Like, why am I keeping it on SPY and not going to like a stock?
Stock again, because you mentioned that 4 or 5 years ago you're using this strategy for stock, but I think now you're just doing indexes, right?
Yeah.
What you've learned and all that, if you don't mind sharing.
Yeah. So even when I was trading this approach with stocks, I was still primarily using it on SPY. Like 80% of my account was in SPY, and that's what I've always traded. But then I would venture off into different ones. We can definitely, when I get out of the slideshow at the end of questions and answers, we can pull up stocks with this indicator on it and look at it. Some stocks are more advantageous than others to trade this with. But no, I've always been an ETF person.
So basically, you have applied this strategy in the past 4 or 5 years on S&P 500 as well, and you have been successful.
Yeah. SPY is my primary asset. I've been watching.
Awesome. Got it. So in the past 4 or 5 years, we see upturn, downturns, like crazy market even these days. Yep. So based on what you have learned, it works based on your. Okay, good. Thank you. That's important for me.
Yeah, absolutely. All right. So diving into the handbook is available at app.10%creditspreads.com/credit spreads trading handbook. I'll send that link out in the email as well if you don't know where that is, or also link it in Discord if you can't find it. But essentially, this is the system, and when I mean system, a strategy with rules that's been proven. This is the system that I use for credit spreads trading that I built based on the trend following system that I just showed. So anyways, let's dive into the different types of strategies and break them down to kind of walk through that. So if we're looking here, the first one that we're going to discover is the squirrel strategy. And again, it's named this because It's a weird name, but I wanted to come up with weird names so that it's memorable. But it's essentially, if you've ever been driving down a road and a squirrel starts to cross the road and then it goes back and forth until like the last minute where you think you're going to run over it, and then it picks a direction. Squirrels don't know what they're doing in situations, especially on the road. And so with that is the idea of this strategy. The strategy works best in neutral and sideways markets when the market doesn't exactly know what's going on. Now, again, what is this phase? This is when we're in the gray area. This is the phase that we're talking about. Between the plus and -1 standard deviation is where we see this play out. Typically, when I was trading stock, and I say stock, SPY mainly of the strategy, I had to stay out of the market during the gray periods because there was no clear direction and I could not trade it. But now, because we're using credit spreads, we can go out, we can be safer, we can trade credit spreads in this environment. And this is a strategy that allows us to do it. So if we look here, it says number one sets up the criteria of what we're looking for. We want to wait till the stock is inside the trending band. Again, as I just discussed, that is +1 and -1 standard deviation of the 200-day moving average. Step 2 is determine your short strike price for the put credit spread. That's going to be the close price times 96%. So let's look into that here. So we're going to wait until the stock gets inside this band. Essentially, it just means wait for the stock or wait for the ETF to be range bound. Wait for it to show some sideways action. When we do that, now we're going to look at the current closing price. So again, let's say the current closing price is $100 just for easy math. Then again, like it says here, we're going to multiply the close price 100 times 96% or 0.96. So essentially, we're taking 4% away and we get $96. So now our short strike price for this put credit spread will be $96. And then again, we're just going to naturally take 1 under as our protective put if we're doing a $1 wide. And so that means we're going to sell the 96 strike price and buy the 95. Okay, so those are our strike prices. Now, how do we determine our expiration date? For this, what's found to work best is taking numerous months of testing to figure out the best days, is the current date plus 14 days and then round to the next Friday. So essentially, wherever we are now, add about 2 weeks and round up to the next Friday. And that's going to be the expiration day you want to pick. That gives us enough time to collect enough credit, allow the trade to work in our favor, and just statistically, back testing wise, has worked out in our favor. And over the last 6 months of using this strategy, it works as well. And so again, that's what I see, and that's what works best. And so again, we're going to take that expiration date that we have now. We're going to take the short and long strike prices that we determined, the 96 and 95 level. Again, if the stock close price is at $100, and then we're going to go to the broker and set up our trade. Now, rough numbers, we'll get into this in the rules here in a second. It's just try to collect at least 15 cents. If you can collect 15 cents for this credit, then it's a good trade to put on. So that is the squirrel strategy and how you walk through it. So when the market is neutral, we're going to go out 4% from the current price, set up a put credit spread, go about 14 days out, and then we're going to trade that, and that's how we're going to do it. Now, why does this work? Why are we taking a more bullish approach in a sideways, undetermined market? Well, when we're trading in a bullish market, as we'll see in the next strategy, we can go less out because that's how we're going to collect the normal credit. But when we're going in a sideways market, we need to go further out. And so that's why we're going 4% out. So we're going a very safe distance out of the money and allowing the stock to work. But overall, the S&P 500 has a bullish sentiment. Over the years, the market always increases. And so even if we have these weird phases of these sideways markets, unpredictable action, long term, there is more of a bullish leaning to sideways action. And so because of that, it's safe to take a further out put credit spread and put on those trades. And so that's how this strategy is structured. Were there's any questions you have over that strategy so far?
Not right now. I actually spent almost an entire week go through your entire trading platform. I have like 22 pages of notes, but
Sweet. Yeah, then
but
I'll get
thanks,
through this
thanks
quickly.
for thanks, but thanks for explaining, especially that part where we're gonna put credit spread, because this you're explaining the S&P is usually a bull market. So I kind of get it.
All right, I'll kind of get through the rest of these and we'll go into Q&A since I assume that's going to be where a lot of the questions get filtered out here. So here we go. So strategy number 2 is the true turtle strategy. This is our uptrending strategy. This is when the stock is above the green line, but also below this yellow portion, meaning that it's not quite overextended yet. And this range is when we'll be using the turtle strategy. So again, this is based on the people called the turtle traders, back with Richard Dennis, who is one of the founding fathers of trend following. And what he did is he made a bet with one of his trading buddies. He's like, I bet I can teach someone who has no market experience simple trend following rules, and they can become profitable. And he did, and he hired people like teachers, accountants, people off the street, just random people, and he got a group of 14 people, some who had market experience, some who didn't, and they went on to make over $100 million trading simple trend following rules. And so that's called the turtle strategy. So this strategy is based off that idea of buying breakouts in bullish markets. So this is our bullish uptrending market strategy. And so again, this is the strategy that will occur the most number of times. You will see come up a lot. Why? Well, because the market, as we just previously discussed, is more bullish than bearish. We see it playing out a lot. And because of that, this strategy has way more occurrences. Anyways, like I said, number one, we want to wait for the stock to be between the green and yellow line, the +1 and +4, basically just trending higher. We're going to determine our short strike price by doing 97%. If we could do 96%, like previously mentioned, where we go down 4%, then we will. Why? Because the further you go out, the safer you are. However, when the market is successfully or reliably trending up, what happens, a lot of fear comes out of the market. So we have a higher fear index, or I should say volatility index, when we're in this gray area than we do when we're above here. Why? Because when the market's consistently trending up, no one's scared that something's going to happen. Like, oh yeah, the market's up, blah, blah, blah. But when we have this up, down, sideways action, no one knows what's going on. Volatility is increased. When volatility is increased, we can go out further and collect that credit, the same credit that we want, at a further strike price out. So when we're in this range, we can easily go out to 96% or 4% below the price and collect our minimum credit. When we're trading in an uptrend, it's very unlikely that we can go down 4% and still collect the minimum credit because the volatility is lower, and so we can't collect as much credit. So that's why on this one, we're going down 3% below the price to collect that credit, because that's where that credit is, and that's the furthest we can go out. That's kind of the plan for that. So we're going out 3%. So again, if the stock's close price is $100 for that day, then we're going to multiply by 0.97, which gives us $97 as the short strike, which is $96 we're going to buy for the protected put strike. Then again, our expiration date is a bit different. We're going to add 12 days and then round up to the next Friday, so a bit different than 14. And that's going to give us our expiration date. Once we have all these, how we set up the spread and our expiration date, we're going to set up in the broker. In general, if we can collect 15 cents, that's a good trade. We put it on and we move on to the next trade in the next few days. And so that's how the turtle strategy works.
Hey, Austin.
Yeah.
So let me just, because I think this part is important. So with the previous strategy, which is the squirrel strategy, where the market's going sideways, usually at that time the VIX is a little bit higher, meaning the volatility is a little bit higher, and because of that, you are going out of to, I think, 96%, right? Is it 96%?
Yeah, just 4% below.
4% below, so that we can at least collect 0.15 credits, right? 0.15 credits, because it's more volatile. However, with the turtle strategy, because we are in the uptrending section of the graph, and because of that, the VIX is usually not as high, right, compared to that. So therefore, to collect enough credits, which is 0.15 and maybe more, you are suggesting to go with 97% of the short strike price, right? I think that's what you meant.
Yeah.
Okay, good. Thank you. Thanks.
Yeah. So as volatility changes, you have to go out further or closer to collect the enough credit. So in an uptrending market, I would love to go down 4% and collect that credit, but most of the time it's not possible because the VIX is lower. Right. So yeah, a good range where we see it working historically, and whether that I've seen working, is 97%.
97%. Got it. Appreciate it.
Absolutely. Great question. All right, so first we had our sideways strategy, then we had our uptrending strategy. Now we have our downtrending strategy, so we can make money in every single facet of the market or area of the market. This is the short play, very simple. Short play, short is when you're shorting a stock, you make money as the stock goes down. And so this is our short strategy. This is used in bearish and downtrending markets. This has the least number of occurrences. If you look at our back test, if you look at the amount of times we trade it, why? Well, because a stock or the market, whatever you're trading, stock, ETF, etc., always drops faster than it rises. So what we see is we see it drop super quickly. We take some advantages, maybe 4 or so short play strategies as it's dropping, and then from there we hit a rebound and we start to trade it back up. So again, this does work, but it's more of a quicker, faster paced type of strategy, just because stocks drop faster than they rise. It's just a common pattern. But the rules on this is, as mentioned before, what we're looking at is for it to get below this red line, but also above this yellow. Anything down here is our short play strategy that fits this criteria. Next, just like we mentioned in the short play, or I should say the sideways action, which is a squirrel strategy, where we went below it for 4%. Well, now we're doing a call credit spread. So now we need to go above it 4%. And so again, we're going above by 4%. Again, we're able to go above by 4% and not 3% like we were doing on the uptrending strategy, because as the market is dropping, volatility is dramatically higher. So we can collect way more credit. So honestly, we could probably collect the same amount of credit as we would on a turtle strategy, going 3% below the current the current price, as if we did 5% above the current stock price, because of how much volatility is there. However, what we found works best is going 4% above the current price for our call credit spread. So that means if the close price during this criteria, when it's trending down, is $100, that means that we're going to sell the 104 call, and then we're going to buy the 105 call, because we got to go above it. So we're going to buy the 105, and that's going to be how we structure our call credit spread. Now, because this moves faster, again, what we see here is our expiration date is going to be a bit shorter in time. So that's going to be about 9 days, and then going up to the next Friday, and that's going to be our expiration date. We're going to plug that into the broker with all the details we determine. If we can collect at least 15 cents, which we're more than able to at 4% in this high volatile period, then again, we collect the 15 cents and place that trade. And that's how we do the short play.
Can you show the graph again if you don't mind?
Yeah, of course.
And which section are you referring to?
Below the red, above yellow. So all these down moves.
Got it. Thank you.
Yeah. So we have these down moves here, which is anything below the red, showing that, hey, we're moving down, market sentiment is down. But as soon as we hit this yellow line, as we'll discuss here in the next strategy, then we start to get into bounce territory. So once it breaks below this yellow and starts recovering, now we're in a recovery mindset. So we're not going to be shorting. So that's why shorting only takes places in this area, or like this area. This area here, it would trigger as well. This area here would trigger. But again, those are short plays. These are more of like dip bounces, which we'll discuss here in this next strategy. So we have the winning whale strategy. This is because whales are just in the investment world known as big buyers, whether hedge funds, investment firms, insider knowledge, where they go in after crashes or after bad news and buy up a huge portion of the stock or ETF, and they see that recovery. Those people are called whales, and that's how they're trading. So this is the same idea, where we're going to come in after a market crash or recovery and kind of buy that dip and make money on the movement up. And so again, this is our bullish strategy that capitalizes on the market recovery when big institutions and investors typically buy into. So our entry for this is going to cross back above the bottom yellow line, or the minus 3.8 standard deviations, which is going to be the 200-day moving average. So it's essentially this bottom yellow line right here that's pre-programmed into the chart. Once we break below this, and then break back above it. So again, we cross below and then cross back above. That is the entry sign that we're going to be looking for a recovery and entering put credit spreads for that. That's the criteria. Next is we're going to determine our short strike price by going out 4% from the current price. So the stock's trading at 100. We're going to go to the 96 strike price, and then we're going to buy the 95 for our protective put. our expiration date is going to be set up exactly like we do for the sideways market. It's going to be 14 days, then round up to the next Friday. So that could mean that it's the expiration date is 14 days, could be 15, 16, 17, something like that. Next is we're going to plug in all these details into our broker. If we can collect 15 cents, that's a good trade, and we put it on. But that is the dip buy strategy, where we're looking to look for a huge crash. We see that recovery after it comes back above it, and that's the movement up, and that's the put credit spread bounce trade. Any questions on that?
No. I think you just covered it well, right? You're still at the winning well strategy, right? Okay, good. I think when I read the notes, I think the winning well, and the next one, which is the elastic bounce, it's quite similar.
Yeah.
Is it identical? Or was it identical?
No, they're not. And I'll cover how they're different here in a second.
Sure. All right.
Yeah. So next we have the one that you just mentioned, which is the elastic bounce strategy. Again, this is when a stock has mathematically hit its low and it's not projected to go lower. And so this is different. We have a bounce strategy where we think the market's going to recover. And then we have levels where we think the stock is just overextended and probably won't go much lower. And so that's the main difference. So if we're looking at the chart here, this is how it's shown. You can see here we have this period where the market gets below. This would trigger a short play strategy. We trade call credit spreads down, then it breaks below this yellow line. As soon as it breaks below this yellow line, mathematically we are outside of 5% of our trading range, and so there's a 0.5% chance that we really massively crash after breaking below this line. And so because of that, once we break below this bottom yellow line, we are in the elastic bounce ruling. And so what that means is we're going to start entering put credit spreads that are further out with a lot of time. Why? Well, because it doesn't stay below this line for long. You can see here, this is probably the longest period here in this outcome. But again, we can show over the history that it only stays below this bottom yellow line for maybe a half of a month max, right? So if we go out with a put credit spread trade where we go out quite far and give us time, then we're going to actually profit underneath this yellow line. And so that is kind of what more of the bounce / winning well strategy is, right? Because I think it is here. Yeah, cross below the bottom of the yellow, which is the standard deviation, that triggers this. And so again, we're going to do what we normally do, which is the same as the setup as the last time, which is a 96%, 14 days out, set up that trade in a broker. If you can collect 15 cents, that's a good trade.
I was comparing the notes, the two entry rules for elastic bounce, and I think this one is identical. And elastic, is it? I'm sorry. Oh, I got a little confused. Which two did we just cover? Elastic bounce.
Yeah.
And
so the winning well.
I think they're identical, the entry rules. Am I correct?
So most of these rules are identical, except in the fact that here on the winning well, we want it to cross back above the bottom yellow line, versus this one is crossed below the bottom yellow line. So in the chart here,
hold on. I just want to make sure. Could you? Sorry, because I didn't catch that. Okay. So the winning well. Can you I'm sorry. Can you go over it again? The winning well.
Above, so the winning well, as stated here in our criteria of the entry rules, you're waiting for the stock to cross back above the bottom yellow line. So that means it's crossed below it already, and now we're waiting for it to return and come back above that line. Versus the bounce, we're just waiting for it to cross below that bottom line. So for here, going below would trigger the bounce, coming back above would trigger the winning well.
Below the bottom yellow line. That's the elastic. Sorry, could you go over? I'm so sorry. You went a little bit too fast. What was the out of
below this yellow line is the elastic bounce.
Below, right? Cross below the yellow line. Thank you. Thanks for sharing.
And then as soon as after it's been below and then it breaks back above, that's the winning well.
But the entry, okay, so that's only difference between the two.
That's the only difference. Everything else is set up exactly the same.
Okay, good, because I didn't catch that.
And if you want to, you could combine them into one, but I just like to segment them.
Okay, awesome. Thank you.
Yeah.
When you say if I like to, when you combine to what does that mean? What are you implying?
Well, I'm saying like they have the same entry criteria, as in we go down. I mean, not criteria, but same put credit spread structure, as when we go down 4%, we have the same expiration date. So as soon as the stock breaks below the yellow line, you could just keep trading that same the entire way. There's just a difference here between. Yeah, go ahead.
Yeah, because I think it will cross down the yellow line. We can use the same entry rules. As it bounces up, we use the same entry rules again, right? That's what you're implying. Good, thank you.
Okay. The last strategy here is the elastic rejection. So if we look here, we have an area where the stock hits outside of its normal trading range and then it bounces back into it. Here we have it bounces outside of its normal range to the upside and kind of pulls back, which is what we're in right now. We were trading outside of the range for almost 2 weeks. And then now we're kind of recovering because we were outside of that range for too long. And so now we're in that pullback phase. And so this is the elastic rejection, hence why if you were watching the algo over the last week or so, you've seen a couple elastic rejection plays come in for SPY and QQQ, and that's because of this setup right here. And so one, we wait for the stock to cross above the top yellow line, so it's going to be +3 standard deviations. So when it crossed above here, that's where we trigger this. From there, what we see is that we want to set up this by going 3% above the current price. Why don't we go 4% like we do on most of our call credit spread strategies? Well, because like I said, when we're trending up and naturally moving higher, volatility is lower. So we need to move closer into the current stock price in order to collect that credit. So 3%. So if we're trading at $100, then we're going to sell the 103 strike price call. Then we're going to buy the 104 for protection. The difference here, this one is the longest one that we have trading going on. So when we're trading this elastic rejection, we're going to be in this trade for almost 3 weeks, if not more. Why? If you look at this here, we have a 19 days, which is more than what is most recommended. Why? Well, because stocks can continuously trend up, but stocks won't continuously crash. You can see here we have crash periods, and then it gets tired, and the market just has like, okay, we need to at least bounce somewhere, and that just happens more frequently. When we come in here and the market's trending up, it is quite hard to kind of reverse it. And so we need enough time in our trade to allow it to reverse back down, at least have a small pullback. And so I've tested it in 19 days. It's just the best days out. So we use our expiration date with the call credit spread structure. We plug it into our broker. We can collect at least 15 cents, and that's the trade. And that's what we put on. And any questions with that one?
No. So the nice thing is you can place your trade any time of the week. It doesn't have to be the first day of the week, trading week, or anything like that.
Correct.
Yeah, but your exiting rules is but the expiry date usually has a math on it as a Friday, I think.
Yeah, just Fridays are just because that's where most expiration dates, the most popular ones are. And so it just works out best that way. Plus, you can't, especially when we're looking at SPY, the integration of Monday and Wednesday expiration dates, the new concept. So we can't back test on Monday and Wednesday on expiration dates because they don't go that far back. So Fridays is the expiration date. Anyways. All right, let's dive into the rules here. There are a few rules. First off is credit collection. You've noticed in most of these strategies, I said collect 15 cents. That is not a lie, but it is a bit higher than what we typically collect. We do like to collect 15 cents if we can, but essentially here, I'll just read it and then explain it. You want to make sure you are collecting enough credit based on your historical win rate to give you a long-term positive expectancy. This means you need to make enough money on your winners to offset your infrequent but larger losses that occur. The minimum credit you should aim to collect varies based on the win rate. I provide this minimum credit in the program with the algo. On each algo alert, it shows you the minimum credit you want to collect based on the win rate. But again, a rough rule of thumb, if you're placing the strategy and you don't know the historical win rate, is collect 15 cents and you'll more or less be safe with that. But again, there are strategies in the 96% win rate that you can collect 11 cents and still end up with the same return long term. But again, as always, if you can collect more credit, absolutely go for it. Sticking with the rules, then you'll be more than set. But 15 cents is roughly where we're at, and the algo shows the specifics. Any questions on that rule?
No.
Cool. All right, trade sizing rules. This is just for risk management, just because as we know with credit spreads, our winners are small. We have a lot of them, but they are small, and our losers are a lot bigger. And now again, as we'll be going next week into how to manage losers and risk management and credit spreads, the first rule we want to look at is how are we sizing in each one of our trades. And so again, this is an important rule and lesson to remember when trading credit spreads because of how large your max loss tends to be. This is why you should strive to trade small and trade often to increase your number of occurrences and decrease the amount one single loss impacts you. The general rule is to put no more than 10% of your total account size in any one position. This rule is subjective and can change based on your trading experience and risk tolerance. Again, when I say subjective, I mean less than 10%. I do not recommend exceeding 10. So subjective means like you can be anywhere from 1 to 10 based on your comfort level with the max loss. If you're brand new, I would encourage you to trade with 5% of your trading capital until you build up experience and confidence. Again, this comes down to a lot of different factors. Number one, what's your experience with trading and credit spreads? If you are comfortable with that, you're comfortable with risk, you can definitely put on more. If you're not, start off with way less, maybe 1 to 2% of your account, and then slowly size up. But also, if you have a larger account and you're just more, I want to safely grow my account, then do a 5% range. If you're like, I have a large account, but I want to grow it as fast as possible, then yeah, maybe it'd be closer to 10. Just understand the risk that you're taking. Me, I personally stay at the 4 to 6% range. Roughly 5% of my account goes into each trade, and that's how I do it. We'll get more into other things later, but that's how I do it. Anything on that?
Okay.
All right, then we get into some early exit rules. So we first started off, I created this strategy. I was using it for SPY, for a few elect stocks that we can probably discuss about here afterwards of this trend following approach. Then I brought in credit spreads and I was just holding until expiration and I was still having roughly a 90% win rate. Then I was like, all right, because every single Tuesday, for those who don't know, I take ideas that I've heard from inside the group, from other traders that I listen to on YouTube, and I test adding different ideas, rules, and stuff like that to see if the win rate and long-term return can improve. And this is one of the early improvements that I made is an early exit rule. It will actually increase your win rate long-term. But again, we're talking by a matter of increasing it by 2% or 3%. Nothing massive. So if you want to hold until expiration because you pay a lot of commissions and you don't want to pay a commission to exit, then it's completely fine not to. But again, I personally exit early because I'm using Tastytrade or Tastyworks now. No, Tastyworks now, Tastytrade, and they don't charge me to exit. So if this exit criteria happens, then I join it. Anyways, here's the exit rule. Exiting positions can statistically help you increase your win rate, take profits sooner, and allow you to redeploy your money into another trade faster. That's just what we do when we take profits early. But there are some rules with exiting the trade early, since the strategies mentioned above, assuming you're holding until expiration. Here is the rule, and there's a 2-point part, and I now realize that the second part in here is not in this document at the time that I screenshotted, so it will be updated by the time I do this. But I've said this numerous times in the chat, and I realize it's different here, but it is this, not number one, which is here. If you can buy the credit spread back for 5 cents or less, then you should. But the second part is, and if there's more than 5 days left until expiration. So if you're at 5 days, good. If you're at 6 days, good. If you're at 10 days, good. If you're at 4 days, you shouldn't apply the early exit rule. So again, that's kind of how this plays out. If you have 5 days or more left until expiration and you can close the credit spread trade for 5 cents, then it's best to take your profits and roll in. Now, why is this the case? Why would you not just let it happen? Well, okay, once you get to roughly 5 cents or 0.05 left on the credit spread and you have more than 5 days left, you've collected most of the profit you're ever going to collect. The rest is due to intrinsic value and that extrinsic value breakdown. You've collected most of the profit you can. The rest, it's just going to hover around 4 or 5 cents, even if it's super far out of the money, just because that's what it does with so much time left. There's just value in the contract because of time. And so you collected the most of the profit that you can. So it's best to just close out and re-roll. If you're, let's say, oh, it's now 4 days until expiration, it's trading at 5 cents. Should you close out early? Unless you're super fearful? No. Why? Well, because you only have 4 days left in the trade. If it's trading at 4 cents, you're far enough out of the money that you can just let it expire worthless, typically. If you're super scared or you're going somewhere and you can't monitor the trade, then close that trade out. For instance, there was one instance you can actually look back in the Discord, in the trading alerts. I don't typically break this rule, but I did one time where it was a Wednesday, I think, and I had some trades that closed on Friday, and I was leaving and I was going to a conference. I was going to be in a plane. I was going to be busy. I wouldn't be checking the market much, and it was trading at 3 cents, so I closed it out. That was purely because something could happen and I'm not there to manage it. So that's one way. If you want to break it, that makes sense, but that is the early exit rule. Questions on that?
Nope.
Cool. All right, last but not least is the counter trend trading rule. So this comes in when we're talking about trading against the trend. Most of the time we are trading with the trend. That involves trading the turtle strategy. We're trading up. We're trading the sideways market. When the market's trading sideways, we're trading with it. We're trading our strategies for it.
I don't think this is in your handbook that I downloaded.
It should be. I just pulled the screenshot this morning.
Really? Did I missed it? My goodness, that's interesting.
Yeah, it's the last thing on the very bottom of the handbook.
Okay.
Yeah.
Okay, let's continue.
We can take a look at it again after I cover this because it's my last slide. So we have counter trend rules. So for instance, if we're trading with the trend, then obviously our success rate is going to be high. We're going to win because we're trading with the trend. We will have losses, of course, that happens, but we're very safe when we're trading with the trend. However, there are times when we trade against the trend. For instance, currently what we're doing now, when we have an elastic rejection setup, which is what we're having right now in SPY and QQQ. We also have elastic bounce. So for instance, these are betting on the market to reverse. Like, hey, I think we're overextended. We're going to try to make that move down or back up. So we're trading against the trend. Although we have a mathematical assumption that it's going to return back down, it still is against the trend. So we need to place some rules in to help better protect ourselves. Because when you're going all in on these reversal plays, you could definitely mess yourself up fast. A lot of members have done this. So I wanted to make sure that I had clear rules. These rules have been added to the trading handbook maybe 2 weeks ago. So it is newer. But again, it should be there. Anyways,
okay, maybe I downloaded 2 weeks ago.
When you first joined. So yeah.
Yeah.
Okay, the first rule is to only enter the trade on a strong green day for the rejection strategy or a strong red day for the bounce strategy. So what does this mean? It means that we're looking for a very strong move in the current trend direction. Why? Because if we're already overextended and another dramatic move happens that's outside of normal range, SPY, the chance of SPY moving over 2% in a single day is very unlikely. And doing that multiple days in a row is very unlikely as well. So if we're already in our overextended territory, which means we're above or below those yellow lines, and then another dramatic move happens, the likelihood of it continuing in that direction is quite low. So that's why if we're doing the elastic rejection, we want to look for a strong green day when it's already over that yellow line, or a strong red day when it's already below that yellow line for the bounce strategy. And again, we're always going to prioritize going further out of the money over collecting more credit. Why? Because we're betting against the trend. The trend will continue. So during these periods, especially during the bounce, our volatility is high, so we can typically go out further and still collect a lot of money or the credit that we need, so we can go out further. So let's say we follow the system, we go out 96% if we're going down, or we go out 103% for the calls, right? And you can go out further, That is the safest way to trade these. Next, the second rule is to size down and only trade with 50% of your typical size. So if you're typically using 10% of your account, stick to only using 5% of your account for that trade. Why? Well, because these trades have one of the lower win rates. I mean, it's still in the 90% range, but lower win rates because, like I said, we're betting against the trend. Now, again, if you go further out than recommended, you'll increase that win rate, but it's still better to be safe than sorry. Size down. Yeah, it makes any loss less devastating. I don't know why my nose is switching. Makes your losses less devastating to your account and allows you to emotionally see the trade through to completion easier. All right, the third rule is to immediately close out any open counter trend positions if one of the counter trend trades expires in the money. So what this means is, let's say we have a current trade and it's Friday and expires in the money that was the counter trend trade. It was a elastic rejection or elastic bounce trade. And what happened was it expired in the money, or we lost on that trade, and we have a trade that's going to expiring next week that's also a counter trend trade. It is best for us to close out that trade now, take a super small loss, because the likelihood of that turning into a loss is high as well, because the trend is shown to continue. Just statistically, it's not going to work out. So it's best to close that next trade. And again, we take a way smaller loss than letting that expire in the money, which has like an 80% chance of doing. So that's kind of what we're doing. So it says right here, yeah, for instance, yeah, here's the actual number. For instance, there's a 75% chance that one rejection trade expiring in the money will result in the next trade that next week being a loss as well. So that means it's best to close that next trade early. And that's the counter trend trading rules. Any questions on that right now?
No, I think I need to reread the notes and really understand this part.
Yeah.
So
yeah, the trading trades, the credit spreads trading handbook is available at app.10%creditspreads.com/credit spreads trading handbook.pdf. If you want access to it and for some reason you can't type this in, just message me on Discord, or I'll include it in the email with this recording. So it'll be down there too. Again, the algo does all this math and work for you. It looks at the indicator that I showed you. It breaks it down, does all the math, whatever. And now we have this. It shows us our historical win rate since 2005. It gives us the annualized return. It gives us the credit collected based on the win rate. You can see here a 90% win rate will be around a 15% credit collection. But if you make a higher win rate, roughly 93%, you don't need to collect as much. Again, if you can collect more, wonderful, but you don't need to have the same long-term return. And that's kind of what we're seeing here.
I do have a question here.
Yeah, go ahead.
Actually, I was supposed to have a list of questions, but I deleted it accidentally. But I remember I have a question here. These are the alerts that you gave us. Why do you show us why do you give us the historical win rates and the annualized return with a percentage? If we're gonna follow the system, all I care is, you know what, dates of alert, expiry dates, details, collect at least blah, just click it. Why would you give me the information of the historical win rates and the annualized return? If I follow your system, I'm not gonna care about those two numbers. Am I correct? Or am I reading something wrong?
I mean, yeah, if you have complete belief in the system, for sure. However, a lot of people will just want to look at, okay, what's going on with this alert? What does this strategy do? Why? Because they've never, like you, deep dived into the strategies, why they work and how they work. But also a lot of people, let's say they're trading smaller accounts, like a $5,000 account, and they can only take 3 trades a week or something. They have to look at the algo and be like, okay, there's 6 trades here. Which ones am I going to take? It's like, I'm gonna take this one. It has the highest win rate. So
highest win rate, right? The historical win rate, so that they can make a better decisions, right?
Yeah.
Okay.
So it's definitely not required, but it's a good way to filter down if you can't take all the trades.
You know what? That's very legitimate. It makes sense to me, because I thought that, you know what, if I'm gonna follow your system, I'm gonna follow it anyway, right? I just need to know the strategy, blah blah blah, and then just move on. But I think you have a good point.
So yeah, the homework, as always, start taking small trades from the algo, learn by doing, which I think most of y'all are doing. Read through the credit spread trading handbook. If you have any questions on it or add what I mentioned in this training, please let me know. We're going to have the next coaching call on Monday at 12 p.m. Central Standard Time. So it's going to be in 1 week from now. So it's going to be the 21st. We're going to also, if optional, I'm going to be covering all different types of risk management approaches in the next training video or in our next coaching call. But I do have a couple short videos on YouTube if you do want to watch those on risk management for credit spreads. Not required though. I'll be getting into that here soon. But anyways, that is the end of this lesson. I know it's been a while here, but I want to make sure we have time for questions. I know you have a lot of those. Let's go into questions and whatnot. And I guess you will be the one for questions here. If you're watching this recording and you have questions, just email me or Discord. Anyways, let's
sure. I guess you were saying that you will send us a couple of videos for risk management as well, right?
I can. I wasn't planning to, but I can.
Okay, please send it to us if you don't mind. I have a few questions. Okay, let me see. What was I think you mentioned that you have been trading, credit spread using SPX in the past 5 years. And I think, obviously, I think 3 years ago, when there's a pandemic, there's a big downturn. Would you mind sharing with us what is your annualized return in the past 5 years per year, if you do remember, approximately?
Approximately. I can actually find those real numbers by going through brokers. I've changed. I was doing most of my stock stuff on Toss, and then now the credit spread stuff on Tastyworks. So it's not whatever, but I will look through to get you an accurate number. I can tell you that during, let's see, we're kind draw. Okay, whatever. Here we go. So I was trading. So I started this strategy around here, this December 16th mark, around
2016,
here, around this
2017.
area. Yeah,
Okay.
around here. Because I remember trading this up. I remember trading this whole way, and then
Yeah.
looking at this crash. So I was in this movement here. Um, this was really good. This took obviously a big hit on the account, but again, I made enough moving up, so it kind of balanced out. This market was tough. Why? Because for a good portion of it, from March until like the end of May, I wasn't in any positions. When I was trading SPY with the strategy, just SPY shares, I would completely stay out of the market when it was in the gray zone. So this part of the year was very flat and neutral, and not much happened. This part
But,
of the
but
year,
I'm sorry, did you trade SPY during that part, or no, you did not?
I
You
was
did.
trading SPY. So during
Okay.
here, I had a great year. During here, it was a very break even year. I think it was around maybe 4% or something. Because from what was it, around, January, from around here to here was roughly the same. This one I did well
But
on.
but 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 you should be able to still make money with your strategy with a SPY. It should be more than 4% if you were following your system, your credit spread system on SPY, right?
Yeah, so I mean, like, I was trading here, so we can
Yep.
see like the beginning of the year started around here or whatever. Then again, I didn't close out my position till about here, so I had about a 5% loss around here. Then
Right.
again, I traded this, and it kind of went like up and down, so it wasn't really much, right? It went up and then down and then up and then down, so not like nothing much was here. I don't remember making much here, and then here I just remember sitting on my hands. I wasn't in the market. And then here, I made, but it wasn't much, right? It was only like what, like, yeah, 2% or something. And then this trade here for the rest of the year, that took it to maybe about 6%. So maybe I made around six. I don't, I'll get you the exact numbers,
No, it's
but
fine. It's fine.
I just remember that this year compared to this one being a lot less.
Understood.
This year, I remember doing well. I really liked this year, primarily because I stayed out of the market here. And then when it dipped below and then broke back above, I bought into the market here because of, like I said, the dip buy strategies that we use, right? It's overextended. So I bought in SPY here and wrote up shares there. I did that on SPY and PayPal. Where was it? In the same period. Was it this year? 2020? No, that's not right. Same period. No, it was 2020 then. That was a different scenario, but yeah, I traded that. Anyways, but we're going back to SPY. Yeah, so I traded this bounce here and then rode that bounce up and then just followed the strategy here. And then here in this sideways market here about 2022 is when I started looking in and exploring credit spreads, and then I started messing with ideas. And then around here is when I started actually back testing and proving out those strategies. Why? Well, because I'm not in any trades during this period, right? When I do my just shares trading, because it's downtrending and I don't short. So I wasn't in any trades during this period. So I got bored and I was like, oh yeah, I can use call credit spreads instead. And then so that's when I started testing options. And then now we're kind of in that mode.
Good.
But
Good. Oh, no, thanks for sharing. And then other questions I have is what other books or papers would you recommend us to read or to look into to master this course or to master your credit spread trading system?
yeah, so I mean, the credit spread trading system is quite easy to follow. Like I said, it's pretty laid out for you. It's really easy to understand credit spreads themselves, right? They're just a high win rate trade. but the underlying approach is where it all comes down into what is the trend? How do I follow the trend? How can I know the trend works? One of the best resources on trend following is trendfollowing.com. Michael Covell. It's not required. All the stuff that I'm mentioning now is not required. You don't need to do any extra reading or stuff for this course, but if you want to, Michael Covell has a trend following book, and it is huge, it is massive, and it is comprehensive. You can definitely check that book out. So he has a lot, but the one that I'm referring to is this one, Trend Following, How to Make a Fortune, Bull, Bear, and Black Swan Markets, Michael Covell. That's a great book. But also he has podcasts. You can listen to him. But anyways, all those books. But what I want to showcase here is one of my favorite sources. I believe I linked this in the Discord earlier, was the performance, him going through the different reports here that have been done. Bill Dunn, which is an investment firm, it's called Dunn Capital, and they have continuously outperformed the market since the 70s, using trend following. Again, here's one point from Mulvaney Capital. He has them being updated since the mid 1999s and that's not mids, it's late 1900s. And so again, you can see here most of their years they're winning. You can see losers though here and here, but I also love just like during these crazy markets like 2020, they have an 18%, they have 32.89. Just these different phases. Like we can see 2008, which is a bad market, they had 108% return. Why? Because when you follow the trend, it just tends to work. But these are a lot of great stories, metrics, firms that use trend following that you can study and look into to build the confidence and system for trend following. But outside of that, for the strategies that we use, it's all laid out in the handbook, and that's kind of what we do here.
Understood. That's all the question I have, but I have a special request if you don't mind.
Yeah.
Could you help, if you don't mind, could you help me to set up my indicator in TOS? I tried to click on your link, but it didn't quite work.
Yeah, you're good. Yeah, I'll stop sharing now. This is kind of the end, and I'll give you permission to share your screen and we'll walk through it.
Thank you very much. 1 second.